Principles of Accounting 1, Chapter 7. In Chapter 7, we talk about receivables. So we start in talking about our accounts receivable account. So companies maintain their receivables as part of their assets. So we have that this graph shows the dollar amounts of receivables and their percent of total assets for four companies. A company must maintain a separate account for each customer that tracks how much that customer purchases, has already paid, and still owes. This is called a subsidiary journal, where we have accounts receivables journal where we have accounts for every single individual customer, and then our main account, receivable T account, shows the total that is in all of those subsidiary T accounts. We're going to look at various transactions that affect accounts receivable. So one is a sale on credit. So this is a sale on credit if the customer, if this company provides credit sales or a company sponsored credit card. Then we would have an accounts receivable and sales. When we record the collection of sales, we receive cash and we would credit an accounts receivable. So you see that we're just focusing on the sales and receivables, but that does not mean that if we were recording for merchandise inventory that we would also need the transaction for cost of goods sold and the merchandise inventory account. When we look at the sales on credit in our accounts receivable ledger, you can see these transactions here, where we have our general ledger for accounts receivable, and then we have our accounts receivable subsidiary ledger, where each company that is one of our customers has their own individual account. So we know which customer owes us money at what time. This is looking at sales on a store credit card. So we have a store credit card that we allow customers to purchase on. So we recorded sales on a credit card in the amount of $1,000. Then at the end of the month, we need to make an adjusting entry for any interest earned at that card. So we have a 1.5% per month on seller interest. So if at December 31st, that customer has not paid us back, they will have accrued interest on that credit card that needs to be recorded in an adjusting entry. If we sell to people who use a bank credit card, so this is a credit card that is used through Visa, MasterCard, Discover, American Express, or our individual bank, whichever bank you're with. When people pay using credit to companies, companies pay a fee. That fee varies based on what credit card supplier. Some credit card companies, like American Express, charge higher fees for accepting credit cards than others. We just have a general 4% fee on this credit card. So then we record that sale as cash because the customer doesn't owe our store for that credit purchase. They owe Visa or MasterCard for that credit purchase. And Visa or MasterCard is just going to give us sales. So we treat that as a cash sale. But we also have a 4% credit card expense that we need to record. So every time we make a transaction, we receive money, but then we also pay a portion to the credit card company. We can also have sales on installment. So this is when customers owe us money and that payment is required in periodic amounts over an extended time period. We're generally charged interest as a customer. So examples of sales on installment would be like a car purchase, where you make a monthly payment for 60 months or 5 years, or even a furniture payment if you buy something for furniture where you might have like 3 years with no interest if you pay a specific amount every month and have it paid off within 3 years. Next, we're going to talk about what happens when people don't pay their accounts receivable amounts to companies. So some customers do not pay their accounts, and those are called bad debts. We then have two methods of accounting for bad debts. We have the direct write-off method and the allowance method. The direct write-off method, we record and write off a bad debt. So we have a customer that owes us $520 and we've determined that they can't pay it. So we write that off as a bad debt expense and we clear their account receivable. So the specific customer is noted in the journal entry so that that entry gets placed on that customer's subsidiary ledger account. If then that customer decided to pay us later, so you'll note that the previous write-off was on January 23rd. So we've written that off as a bad debts expense. We removed their accounts receivable amount. Then on March 11th, they paid us what we had previously thought was a bad debt. So the first thing we have to do is reinstate that account receivable and remove the bad debts expense. Then we record that we received cash for the closure of their accounts receivable. Now, the direct write-off method does not best match sales and expenses. So it doesn't follow that expense recognition principle or the matching principle, which requires expenses to be reported in the same accounting period as the sales they help produce. And the materiality constraint permits direct write-off method if results are also similar to the allowance method. So companies are more likely to use the allowance method because that is the method that is preferred by US GAAP under the matching principle. So now we'll talk about the allowance method. Under the allowance method, at the end of each period, we estimate the total bad debts expected to be realized from that period's sales. And then we record an adjusting entry at the end of the month for that estimate. There are advantages for the allowance method. One, it records estimated bad debts expense in the same period as the sales are recorded. So it meets the matching principle for sales and revenue recognition principles. Then we have it reports our accounts receivable on the balance sheet at that period at the estimated amount of cash to be collected from customers. So when we're using the allowance method, we generally have a percentage of sales based on historic information that we've been as a customer. We generally kind of have an idea of how much is not going to be received. So we have this example here where at the end of the year, we had $300,000 in credit sales during our year of operation. At the end of the first year, $20,000 of credit sales remain uncollected. Based on the experience of similar businesses, we estimate that $1,500 of our accounts receivable would be uncollectible. We then record a $1,500 bad debts expense, which shows up as an expense on our income statement, and then a $1,500 allowance for doubtful accounts. Allowance for doubtful accounts is a contra asset account that matches up with accounts receivable. Then when we see it on the balance sheet, we can show it one of two ways. We can either have separate lines, accounts receivable and the allowance for doubtful accounts, and then show what our total accounts receivable is net of that allowance for doubtful accounts. Or we can just say accounts receivable net, which means that they've already subtracted out the amount of the doubtful